Welcome to ETF Leaders, powered by the New York Stock Exchange. Joining me today is Jeff Sherman. He is the Deputy Chief Investment Officer at DoubleLine. Jeff, great to see you. Thanks for joining me.
Yeah, thanks for having me today.
My pleasure. All right, so Jeff, tell me, what are your biggest challenges in 2022 and how can investors manage their risk?
Yeah, I think the biggest challenge is it's going to be the Federal Reserve because the biggest challenge is inflation. And so we know that the Federal Reserve went from being really accommodative for the last few years, or last couple of years since the pandemic began, and now they're in completely opposite mode. And so inflation is paramount on their minds. They're going to be aggressive this year. They're going to offer a significant number of hikes, the likes that we haven't seen in really 2 decades, and they're going to unwind their balance sheet. And so there's going to be a lot of supply of bonds in the market. There's going to be higher rates. The market's priced a lot of this back in because of the rate hikes, but I think investors need to be very cautious with some of the risk within their fixed income portfolio. So the best thing to do is to be patient right now. It's been a bloodbath in the bond market for the first 3.5 months of the year so far, and the patience has been really paying off for clients. And so building higher quality portfolios, not really delving down the risk curve. I think you want to be increasing the quality of your portfolio, not increasing the risk of your portfolio right now. And the reason is things are going to get more difficult. Less liquidity in the market, it's going to be a little more challenging. And by the way, the last time the Fed tried to unwind their balance sheet, they caused some significant problems to the market. So I think it's prudent to be a little cautious right now. That doesn't mean to avoid the sector. Bonds are getting very interesting again, right? They're getting real yields again, to where there are some attractive levels. So I think it's a patience market and trying to manage those risks in the near term.
Okay. And how do you think advisors should be preparing their portfolios?
Yeah, I think advisors need to think forward, right? We know it's an ugly quarter for the fixed income market. The aggregate, U.S. aggregate, which is a widely followed benchmark of high quality bonds, had its worst quarter ever, right? It's the worst start to a year ever. If at the end of the year, it'd be the worst year ever right now. So instead of focusing on that, look at what the forward-looking opportunity set is. Remember, 9 months ago, to get a 3.5 yield, you had to buy the entire high-yield corporate bond market. Today, you can do that in high-quality investment-grade bonds. So I think as advisors are out there trying to build their portfolios for clients, don't look in the rear-view mirror right now. Look at what the opportunity set looks like. Inflation will come under control eventually. It's going to take a little bit longer than we all think, but ultimately, you're getting to the part where you can build portfolios that over the next few years can generate a real rate of return. So I think it's being visible, forward-looking, and not looking in the rear-view mirror.
All right, now inflation. Are you concerned about inflation?
Absolutely. I mean, that's what we're talking about here. So we got the PPI print today as we're sitting here talking. Headline number is like 1.4% month over month, right? That annualizes out over 14%. The core inflation, so getting rid of commodities, was still 90 basis points. So you're still running almost double digits on an annualized basis. So why I'm worried about inflation is, I just said PPI, which is producer prices. These are input costs. So the input costs remain elevated. They're going to end up in final demand, right? So ultimately, I don't think the Fed can control all of this inflation because we know it's supply chain related, it's commodities related. These things, by raising rates, it doesn't fix it by raising rates. So I think that you should still stay on watch for it, but a lot of the pain of inflation we've already seen. It will remain elevated, as I said. We're not going back to 2% in the near term. But the thing is that wage growth is there. The economy can survive this, but my fear bigger on the inflation side is that the Fed gets way too aggressive and then throws us into a recession.
All right. Well, Jeff, great to talk with you. And that's ETF Leaders, powered by the New York Stock Exchange.